There's a difference between a really bad downgrade and a miss. It's unrealistic to expect companies to hit their numbers every single quarter. I guess where we come from is where we see there's been a material change to the thesis and the competitive advantage, we just exit a business straight away. And the rule we tend to have is if you've got a downgrade and the stock price has gone against you, quite materially, 10 to 15%, let's say, and you're not willing to buy more of that position, you actually have very little conviction, so you shouldn't be there at all. There's a lot of good businesses in the world, and so just because you're in the portfolio doesn't mean that you have an advantage. Mentally we're all wired to, there's incumbency bias. So a stock that's in the portfolio, naturally you try and defend it. A stock that's out of the portfolio, naturally, psychologically, you're always looking for something that's wrong. We try as much as possible to guard against those biases. So we'll normally just cut something if you're not prepared to add. Sure. So let's say there's 70,000 companies that kind of fulfill our criteria globally. So we screen at 3 billion market cap. So that gets us quite quickly down, I think somewhere 11,000 stocks or something like that. We then screen on return on capital, which is ultimately our definition of good business. So over 10 years, an average of over 8%, and over 10 years, a return on tangible capital, i.e. stripping out goodwill and tangibles, an average of over 15%. So that will really narrow down the universe. We then screen out bad balance sheets, roughly 2.5 times debt to EBITDA. We will be a little bit lenient there where the company's got a history of running a good balance sheet and has maybe gone a little bit above that to make a strategic acquisition, and they've committed to getting that debt down quite quickly. We then screen out what we call excess growth. Businesses that have grown faster than the natural growth of that business, i.e. through issuing a whole heap of shares, doing a lot of acquisitions, putting a lot of debt on the balance sheet and a lot of goodwill and tangibles on the other side. And then we just screen out all sorts of industries that basically what I say are leveraged, complicated, commoditized, or regulated. We just strip those out. And so quite quickly we get down to quite a useful working list of about 120 stocks. Now, if you think of the portfolio, the average age, heritage of the companies we own is over 80 years old. The oldest is over 160 years old, and the youngest is Alphabet, I think 1999. So these businesses have been around a long time. So we're not looking for the Johnny-come-latelys or the new hot thing. We're looking for the durable businesses, and obviously by their nature, we don't normally come across, there's something really new that we haven't looked at. I'm going to be boring again and say we're still pretty much like Alphabet. Like I was saying earlier, if you look at the growth the company is delivering, there's still a big opportunity in digital. YouTube is still a hugely unmonetized asset. Cloud, they're very strong, catching up to Amazon and Microsoft. I think the last time I looked, they got nearly $150 billion in cash, which is, what are they going to do with that cash? Are they going to return that to us as shareholders? They have started doing buybacks. I think they'll probably, as they mature further, accelerate those buybacks. And then I just look at the valuation for that sort of growth. Like I was saying, the last result, you've got high 30s revenue growth in their three core divisions. And if you strip out the cash and the loss-making businesses, you're still only paying 24 times. That's a discount to the NASDAQ. That's a sizable discount to where the NASDAQ is today. So that's probably the one that we've consistently run, a very big position in the portfolio, and we are still today because the earnings keep coming through. Possibly. I mean, I think it's unlikely, but there have been situations in my career where, something like, let's take Visa, when Visa was spun out from the banks, I think it was 2006, 2007. So it didn't have that long a listed history, but you knew the business is 50 years old. And you could see that it was absolutely integral to the way we run our lives. Another one was Mead Johnson, when it was spun out of Bristol Myers. You could see again that this is a business that's been around a long time. Sure, we haven't got a listed history, but it was Zoetis that was spun out of Pfizer again. So I think there are instances where, Google, I was very slow. I think when Google listed 2003 maybe, I think I only started getting interested in it in 2009. So I was a bit slow there. So I think we're not going to be right at the forefront. So we wanted to kind of get to a reasonably steady state. We're unlikely to be buying that business at, when it's growing at 50% or 100% and on 100 times earnings. We're going to start getting more interested when it's, we're happy to miss that first bit, because until the industry kind of settles down and we can see who the winners and losers are going to be. Very little, very few. So, but then you do get those unique situations that once in a while, like I was saying, Visa, Zoetis, Mead Johnson, those are three that I can think of where, you just, something like Accenture even, which just fortunately just in time came out of Anderson Consulting before they went wheels up. But, the business, we're not looking at for the spin-off, we're looking at for the business and going, this is a business that's really good and we want to own it.